I'm Greg Hunter. Welcome to USAWatchdog.com. Our next guest is a 10-year financial Wall Street analyst. He's also has a deep career in financial writing. In '98, he said, "Hey, the .com's going to blow up," and everybody thought he was crazy. 2 years later, it did. Back in the housing crisis, a few years before it blew up, I think it was in 2003 or four, said, "Hey, the housing thing, the subprime thing is going to blow up." It did. He was early. And then we have the money bubble that he wrote in 2013, along with his buddy James Turk. I'm talking about John Rubino. John Rubino, thanks for joining us today on USAWatchdog.com.
Hey, Greg, good to talk to you again.
And I just want to keep you up here and just extend your introduction. The Money Bubble, written in 2013. And it says what to do before it pops. And again, you have a track record of being early. Not wrong, early. And it looks like you were early again because the money bubble hasn't popped. This book, The Money Bubble, and I think it's on your website, dollarcollapse.com. Great website, incidentally. This book is on your website. It's still relevant today because the money bubble hasn't popped. Where are we in the popping phase of the money bubble?
Yeah, early does feel like wrong for a little while, but eventually it works out, and that's been my pattern for the last 20 years, as you said. And yeah, the money bubble is basically the big bubble on which all the previous financial bubbles have come and gone, and the money bubble is about money and government debt and financial instruments in general. So it's a global bubble that's bigger than anything that's come before. And that's part of the reason why it's gone on so long, because everybody is participating. Every central bank is armed with an unlimited printing press, and that allows them to fool people by manipulating interest rates and lately buying equities and unlimited numbers of bonds. And that fools people into thinking that the world is basically normal when it's not normal, because debt is soaring and financial leverage and every other aspect is going through the roof, and we're creating the conditions for really the mother of all financial crises. And yeah, it's taking longer to happen than seemed likely a few years ago, but it is starting to happen now. You're seeing the QE programs of the past few years, which were wildly experimental and really shocking to economists and everybody else, turn out not to work. The Japanese, for instance, bought back all the government bonds that there were to buy back and flooded the system with currency, and they're still in deflation. So they're getting ready to try something even bigger. Europe is a complete mess, and even the US, where the headline numbers look pretty good, underneath the headlines, things aren't nearly as good. And so the system is either getting ready to break down shortly, or to go on to a new level of experiments that are going to be even more dangerous and set the stage for an even bigger crisis in the future. So that's the question. When does this blow up? Is it 2017? Or do we buy ourselves a little bit more time with even more money creation and even more financial leverage pretty much everywhere, and push the eventual collapse of the system back to 2019 or whatever? Either way, the current system is toast. And the investment thesis of getting into precious metals and other real assets and out of financial assets stands, and it's going to work eventually.
People, as I said, as a reporter, I was way out in front on a few stories. I was lucky enough to be way out in front on a few stories. And when you're out in front, you look wrong. You're just early. I know that for a fact. I know you're in your man cave and you do dollar collapse out of there, and you're in your man cave and you got to, some creature comforts while you work around. That's why the pool table's in the background and all that. Just wanted to explain that. But dollar collapse, what a great website. I was reading that when I was at CNN. In 2005 and 2006, and I'm thinking I'm trying to poke holes in the stories on there. So I'm not seeing this anywhere on CNN, on ABC, on CBS. Wow, what this internet thing is. Really, hats off to you, dollarcollapse.com. And what about the gold world? A lot of people are like, that, well, gold hasn't gone up. I bought in 2012 or I bought in 2013 and it's gone down. It's gone back up. Of course, thank you, Deutsche Bank, for admitting to rigging the gold and silver markets along with other primary dealers of treasuries. Where is the gold market right now? Can you give some people some insight on what you think's going on?
Well, it seems to have turned. That was a brutal bear market in gold. Normally, they don't last that long. Like the 2008 bear market was this short little crack where everything went down and then it went right back up. And this time around, it was a slow grinding process of gold and silver going down day after day and the mining stocks going down to levels that were inconceivable before the process started. But we seem to have hit bottom. At the beginning of 2016, the trend changed, and gold and silver have been gradually marching higher throughout the year. And the mining stocks that are really leveraged plays on precious metals have rocketed. You see a lot of real mining companies, not the little penny stocks, but established gold and silver miners that are up 2, 3, 4 times this year. And a lot of big names have made a lot of money for a lot of people, but they also bypassed a lot of people because I think that this happened so quickly in the mining shares that very few investors who like that sector were fully invested at the time. So now probably most of the precious metal sector is hoping for a correction so that they can buy the stuff they wish they'd bought in January. And it looks like there's a good chance that that's going to happen in the near term. You don't get this kind of a run without corrections along the way. And this has the feel of one. But the overall bull market looks like it's reestablished. So over the next few years, we ought to see gold and silver go higher, which shouldn't be a surprise because a world of negative interest rates is paradise for real assets, and especially for forms of money like gold and silver that governments can't manipulate. It used to be that if you were going to buy gold and store it in a vault, you'd have to pay maybe 1% a year. You wouldn't generate any cash flow from it. And meanwhile, a portfolio of Treasury bonds might yield you 6% a year. So there was a big gap in cash flow between financial assets and real assets. Well, that's gone now in the world of negative interest rates. It actually costs you money to own, for instance, Japanese or German bonds, whereas gold is still what it always was. It sits there and it retains its value while your bond portfolio actually loses value as you pay rather than receive interest. So this is a phenomenally good environment for precious metals, and that ought to play out over time. In other words, money ought to flow into those sectors, gold and silver, as the next few years progress. And they're tiny little sectors compared to financial assets in general. If just 1% of investable funds around the world flowed into precious metals, it would send them through the roof because there's so much more paper out there than gold and silver that you would see you'd see gold at $5,000 an ounce and silver at $100 an ounce easily. And that's just fundamentals being revealed there. That's not even the panic stage of the process yet. So we could see these things go a lot higher, as crazy as that sounds now. But that's how major trend changes work. And it seems like we're in the early stages of one of those.
John, I'm listening to you talk, and I'm hearing deep experience for analytics and analytical thought, and your writing and all that. It's just really deep experience. I mean, you sound like the voice of reason in a storm. You're like, yeah, it's okay, we're all good. What about these? The Fed and with this constant game of chicken saying they're going to raise interest rates. You got a negative, I don't know, 13, 14, 15 trillion of negative interest paying debt over in Europe, and they're going to raise rents. I mean, wouldn't that crash the system?
Well, that's the box the Fed is in right now. So, you have to remember that the Fed is owned by the big banks. It's not a branch of the government. It's a division of J.P. Morgan Chase and Citigroup and Goldman Sachs. And interest rates have fallen to the point where it's starting to hurt the big banks. They're panicking because they can't make as much money as they used to be able to in this kind of an environment. So they want rates to go back up again, which would widen their loan spreads and make trading easier for them, presumably. So they're putting pressure on the Fed to raise rates. At the same time, as you said, the whole rest of the world is falling into a deflationary abyss, and they're cutting rates and doing other kinds of easing as quickly as they can in order to stave off a 1930s style depression. So if the Fed raises rates and everybody else in the world is cutting rates, what does that do to the price of the dollar? Other things being equal, it makes the dollar go up, which will spook our financial markets and maybe cause a bear market in equities here, which we maybe can't handle anymore. There's a new phrase out there called the too big to fail stock market, which implies that we are so financially fragile that the governments of the world aren't sure that their systems can handle a garden variety 20% drop in stock prices. And that's what the Fed is risking by raising interest rates, a stock market decline that metastasizes, that turns into something much more serious. And so they've got these two competing voices in their heads right now, where the big banks are saying, you got to raise rates, this is killing us. And their own experience and their own fears that if they do so, if they try to normalize rates, that they blow up the financial system. And you know what? Both voices are correct. The big banks are in trouble if interest rates stay low, or God forbid, from their point of view, go down further from here. But rising rates would blow up government budgets, for instance, and private sector budgets, because so much of the world has loaded up on variable rate debt, which means it has to be rolled over. And if rates go up, you have to roll that debt over at higher and higher rates, which means your interest costs go through the roof, and the system might not be able to handle that. So we're in a place where either we have a banking crisis in the not too distant future, or we have a broad-based financial crisis in the not too distant future. And one of those kind of sort of has to happen. We don't have a lot of other choices, because there doesn't seem to be a pain-free way of navigating from this much debt, record amounts of financial leverage everywhere you look, over to a system where we can grow steadily and organically again, back to normal life of the 60s and 70s and to an extent 80s. No way to get from here to there without incredible amounts of pain. And our choice now is basically between kinds of crises. And that's the Fed's problem, because they don't want a crisis. They don't want to preside over some horrendous financial crisis that they will be blamed for. But it looks like they kind of do have to choose one or the other. And so that's why they're
what are the two choices? The two choices are raise rates or not raise rates, right? So what are the two crises that could happen?
Well, from the Fed's point of view, yeah. If you raise rates, you blow up the financial system, because you spook the stock market,
Okay.
you cause everybody's interest costs to go through the roof. The system can't handle that.
Stop. Does gold blow up does gold take a hit if they raise rates?
If it causes a financial crisis, you could see another 2008 kind of situation where gold tanks for a little while and then goes through the roof when the central banks inevitably respond to the crisis with even easier money. So we could see that scenario again, or we could just see money pouring into gold and silver because everybody's terrified, and that has happened in the past too, where interest rates went up, but gold and silver went up even faster. That was the 1970s. And we could see that again. Or during the Depression, when there was deflation, gold went up because gold is money. And deflation, by definition, is money becoming more valuable. Okay, and so people treated gold as money, which it was officially back then. And so gold got more valuable. Same thing could happen again as the market decides that these fiat currencies really didn't work after all. The concept is fatally flawed, and that we're going to go back to real, tried and true, time-tested forms of money like gold and silver. And the amount of capital that exists in the world that could flow into these sectors is so huge compared to the size of gold and silver, that it could bid them up really dramatically. We could see some discontinuities in this kind of a market where things just start to gap up, or things like gold and silver start to gap up, and where one day silver is $32 an ounce, the next day it's 55. And so that's the kind of thing where you can't predict the timing with any kind of certainty, but there is a pretty good chance that if you don't get in before it happens, you won't have a chance to get in, because there just won't be any left. And that's kind of the nightmare and paradise scenario from a gold bug's point of view. That money finally does start flowing into precious metals, they start gapping up, and then that causes other kinds of problems that you wish wouldn't happen. In other words, there could be some kind of a wealth tax imposed on precious metals just because they're going up so much, and that creates a disparity between the people owning stocks and bonds who are getting crushed and the people who have real assets who are making lots of money. Or in the 1930s, we had confiscation of gold because the government was so terrified that it was acting out of desperation and a need to get gold off the playing field so it could increase the money supply at will. So this kind of a scenario is fun in one sense because the stuff you own is gapping up And it's scary in another sense because it leads the powers that be to possibly do erratic, panicky things that disadvantage you. So you don't actually make as much money in your gold and silver as you would have hoped to make. So I don't know.
And the other scenario would be they don't raise rates. So you have a raise rate scenario, blow up the system, gold could go up or down for a short while. And then the other scenario is not to raise rates. What happens in that scenario?
Well, in that scenario, the banks are hurt badly because they're already suffering. For instance, Goldman Sachs, or not Goldman Sachs, Deutsche Bank, Germany's biggest bank, came out the other day and said rates at their current level are fatal for the banking system. And that's a sign of the amount of panic that these guys are feeling in the boardroom. You know, they know what's going on under the surface of their bank and of the banking system in general. And they know that a negative interest rates world is actually not, contrary to what theory says, good for banks. You know, it's not the kind of system in which they can thrive. And so pushing interest rates down even further, first of all, is actually deflationary because it sucks money out of the accounts of savers. You know, you're not making any money in your bank account anymore, so you're not going to spend any money, obviously, you know, since you're losing money in your bank account. And that slows the economy down and causes deflation, other things being equal. And at the same time, it blows up the banks. So that's the scary side of the negative interest rate scenario. And it also will lead governments to accelerate the war on cash. You're seeing economists now say, well, we can't have negative 3 or 4% interest rates if people can still just take their money out of the bank and keep it in a vault, right? So we got to get rid of cash. So at the same time that we're crushing savers and causing the banks to blow up one after another, we're also strolling down the path toward a police state in which the last vestige of financial privacy, which is cash, is made illegal. So there are lots of negative aspects to continued, more deeply negative interest rates. And I think that scenario, though, is actually a lot more positive for gold and silver because, as I said before, negative interest rates are just great for something that competes with fiat currencies but doesn't pay any interest. If fiat currencies charge you interest instead of paying you interest, then why not have your money in gold and silver? Because those are more solid, more long-lasting, more stable forms of money. You know, and if you're not going to make anything on your paper money, you might as well be in the better forms of money. So that a continuation of negative interest rates, which looks like that's what we're going to see because the rest of the world is going that route, no matter what the U.S. thinks it's doing. That will just lead more and more money to flow into real assets. So farmland ought to make a comeback from the recent correction, and well-chosen energy assets ought to look pretty good going forward, and also well-chosen real estate, not bubble market real estate, but you know, a rental house in a college town that's fairly economically stable, something like that would be a good place to put your money as well. And of course, precious metals. Those are the things that everybody hides out in times of crisis. And this is clearly some kind of a crisis coming our way.
Is this what, and I wanted to ask you this because you just said it's such a wealth. People are loving, I can tell you right now, people are loving this interview. They're loving this. I'm loving it. Is this why Gunlock, Jeff Gunlock mentions $100 billion, and Bill Gross, who was at, you know, the bond king, he's now at Janus, he manages billions of dollars. And Soros, and even, you know, I don't know, what's his name? Crispin Ode, I believe his name is, Carl Icahn. Everybody's out with these dreadful warnings. I mean, it's a huge chorus in the last couple of months. Why do you suppose they're doing that? Do you think they're just you know, punking us, or do you think they're warning because they have to, so they don't have to say, I didn't see it coming? Why do you think they're making all these warnings?
It is interesting that you're seeing these heavy hitters who are not perma-bears. You know, these guys have made money long and short for as long as most people on Wall Street have been alive. And now to see the list of household names in the financial community coming out and saying short stocks and buy gold, which is basically what these guys are saying, is interesting. You know, it gives me added security about the idea that the money bubble is starting to burst. In other words, about how James Turk and I, in my book, is finally becoming timely, because could conceivably just be talking their books, trying to make a short-term trade by spooking the market. But I doubt it. That isn't their style. They tend to, if you look at the history of George Soros, for instance, when he takes a big position, he usually means it. The thing that he's betting on frequently comes true in a very big way. He actually broke the Bank of England way back when. That's how he made his fortune. And his name originally was betting against pound sterling and having it work out. They had to devalue pound sterling. Well, now he's putting on a lot of bets like that relate to equities going down and precious metals going up and other related things. And so it's probable that he means it, that he actually expects new trends to begin here that are negative for stocks and good for real assets. And it's probably true for the rest of these guys. I mean, Bill Gross, my God, he almost never says anything about equities to begin with. And for him, a bond guy, to come out and say, I don't like bonds anymore, I don't like stocks anymore, buy gold, it is a pretty big deal. So you never know. You never know what's going to happen in the short run. Long-term trends are more easy to identify, but the year ahead is almost inherently unpredictable. But that there is this much smart money on the gloom and doomy side of things now makes it more likely that scenario is going to start to play out shortly.
And one of the things we talked about in the pre-interview, and you made a great point with this, and that was, these economic upheavals, usually have political upheavals, and that you were pointing out, we had, all this hyperinflation in the 20s, and what do we get? We got, Hitler. And so tell me about what, your idea, just briefly here, about, that this economic upheaval is going to lead to probably a political upheaval.
Yeah, I'm running a long series on dollarcollapse.com called Why We're Ungovernable. And the basic premise is that, when you're a country or an individual or a family, if you borrow too much money, your life spins out of control. And all around the world, pretty much everybody has borrowed too much money. They've leveraged themselves to the hilt, and now things are getting harder. The old ways of doing things, the big multinational and national systems that used to be seen as taking care of people, don't really anymore. And the average person is figuring this out, which means they're more and more open to politicians who aren't business as usual, let's stay the course kinds of people, but instead who are willing to tear the system out by the roots and start over. And you're seeing that all around the world. Brexit, for instance, and Marine Le Pen in France, who used to be considered a far-right, fringe, radical politician, is now the most popular politician in France, and she's anti-Euro and anti-EU. And you're seeing stuff like that around the world. Name the country, and you've got a Donald Trump type who is gaining political traction. And that's not a surprise. That's exactly the way you would think it would play out after 30 years of financial mismanagement on the part of the major governments. You can trace this back to basically 1971, when we broke the final link between the dollar and gold. And at that point, every major currency became a fiat currency. That is, that it exists by government fiat or government decree, and it's anything they say it is. So that was, in effect, handing an unlimited credit card to a bunch of politicians and their appointed bureaucrats. And, human nature being what it is, of course they abuse that power. Since that time, debt at every level of every major society has soared. And so the results of borrowing too much money are always chaos eventually. And we're seeing that now. The world is getting harder and harder to manage. And the only response that the guys in charge have now is more of the same. Every crisis is met with even more easy money, even more currency creation, lower interest rates, and we're reaching the limit of those policies. Now, we might have one more iteration where they do a debt jubilee or double down on quantitative easing or something like that, and that might be the story of 2017. But it's already clear that the average person understands that their government and the multinational systems that their government is now increasingly a part of aren't working for them anymore. That they're basically working for the 1% who make out when interest rates fall. In other words, regular people who save money in a bank or in a money market fund or something like that are hurt by the current level of monetary policy. Whereas rich people who tend to own assets that attract money when interest rates fall, like fine art or trophy real estate or yachts, things like that, those guys are getting richer and richer, while the average person, or actually the 99%, are getting poorer and poorer. So that's a recipe for political chaos, and we're seeing it right on schedule. The next round of elections in the US and Europe are going to be really remarkable because the electorate is ready for somebody who says, you know what, let's just pull out of the EU, forget it. Or you know what, let's impose term limits, or let's impose wealth taxes on rich people, or price controls on drugs. There are a lot of policies that weren't really marketable politically 20 years ago that are now going to start seeming pretty interesting. Oh yeah, build a wall across the US-Mexican border, or kick out all the minorities. This is the kind of thing that's going to start to play, or that is starting to play. And the political establishment doesn't really know what to do with it, because they consider it to be so far out in left field, such a set of fringe ideas, that they don't even want to address it. But now we've got, in a lot of countries, 30, 40, 50% of the people voting that way. And so it won't be a surprise to see more versions of Brexit, for instance, spreading across Europe. Frexit, when France votes to leave the EU, is the next big thing that we might see. If they had the election today, it would win. Frexit would win. They would pull out of the EU, they would pull out of the Eurozone, and that would basically collapse the European project. Spread ideas like that around the world, and you get chaotic political headlines every single day, which feeds back into the financial chaos. Because when politics is unsettled, that makes you a little more nervous about your money, and you're less likely to behave in the ways you used to, where you might buy a lot of growth stocks. Well, you're going to be very nervous about the stock market if you're nervous about your political system. So it's a feedback loop that is self-reinforcing. And I think 2017 is the year when we see the thing really kick into high gear.
John Rubino, I am only ashamed of one thing, and that is it took me too long to get you back on. I have an embarrassment of bookings, but wow, man, you were fantastic. I was trying to take notes, and I'd sit there and I'd be listening, and I'd be, oh yeah, wait, hold on, because I'm getting in here, dude. It was fantastic, really. John Rubino,
well,
this book is on your website, The Money Bubble. It could have been written this week. You could have released it this week. It's The Money Bubble. You and James Turk. There you go. There are John and James right there. You could have been written this week. What do you do before it pops? I will put a link to your fine site, Dollar Collapse. This is going to be on a very easy place to find this book. It's a long book. It's a big book. It's not a beginner book. It is it's simply written. Don't get me wrong. It's not a bunch of wonk stuff, but a lot of charts, a lot of stuff. Really a great book, and it could have been written this week. The Money Bubble. John Rubino, thanks for coming on and taking us to school. Really appreciate it. John Rubino, dollarcollapse.com. Thank you very much for joining us on USAWatchdog.com.
Thanks, Greg. Great talking to you.